thank you for joining. As I said, if you can have your cameras on, that would be great, and microphones muted. Um, we're fortunate to have Ben Stephen hosting our session today, so thank you, Ben. Ben is an investor and advisor in the VC and PE world. He's participated in over 40 transactions, and we thought it'd be a great session for him to share some insights, some lessons learned from going through those processes, and then there'll be a half an hour for interaction where we would love everyone to get involved and just discuss what we've learned today. So if you have questions, probably the best thing to do is pop it in the chat, but we will save those till the end, I think, because we are going to have a good half hour. And then I can just sort of introduce people to ask the question, and we want this to be interactive. So with that, I will pass over to you, Ben, and I will stop talking.
Yeah, thanks, Chris. Hello, everybody. This is this awkward time in the day where it's like, do I say good morning or good afternoon? So I'll just keep it to hello. Thanks, everybody, for joining today. And thanks, Chris and CFO Recruit for inviting me today. My name is Ben Stephen. And yeah, the best way I would say to characterize my background is that I'm a stock market investor who turned entrepreneur, who turned VC and financial advisor. So I spent about 10 years in each of these positions. And most recently, I've been a venture capital investor for several funds. And I've been a financial advisor for larger companies and more in the PE space for non-dilutive funding and other transactions. So yeah, the idea for today is something that is very dear to my heart because it's something that I found through virtually every transaction that I have ever been involved in, is that the fundraising success for companies depends very heavily on the communication and the type of interaction that companies have with investors. And one of the biggest problems there is that there is a, let's say, inherent discrepancy, difference in the perspectives of companies versus what investors do, that does not reflect that there is a conflict of interest. It just means that one party is looking at it like this and the other party is looking at it like this. So, oops, I've prepared some slides. Let me share that to support the story. Now, just so you know, this presentation is, if I get the slideshow going, yeah. So this presentation is having a lot of information on here, so I will share that later. I don't want to read down all the slides, but there's a lot of things I want to cover, and I will not go into every single point of the slides, but I think this presentation will be helpful for you to take a look at later. So yeah, let's get into this. For me, it's all about alignment. Alignment is important to help both parties, the investor, understand what their counterparty is into, and also helps the company to convince the investor that they're basically having the same ideas. Now, typically you look at two perspectives. The company has the insider view, major impact from day-to-day business. Your responsibilities as CFOs are not just the strategic ones, but also the day-to-day business. And companies, when they present what they are doing, is they are talking about what's going on right now, what do we think where we can go, yes, but really dominated by this one company, its product, and the specific industry. And companies typically can be characterized as stewards. So focus on vision, on people, and long-term business outcomes. While investors are typically more having the outsider view. So they're less burdened by day-to-day business. And the bigger difference is actually that investors in their day-to-day business constantly evaluate a large number of companies. From my perspective, from my personal perspective, I would say I had on average between 5 and 10 pitch decks I've seen every day, spending 3 to 5 minutes on each deck, trying to understand on a very high level, where do I want to spend more time? So what does that mean? I constantly evaluate, or investors constantly evaluate things in a variety of sectors, variety of maturities and other dimensions. It's a portfolio view. And the other thing is that investors are fiduciaries. So what determines their point of view is their clients. The investor client is best characterized as other people's money. So the investors have LPs that give them money, and what do they want in return? Well, they want return. So to start with, we have the insider view versus the outsider view, and they don't clash. They just need to be translated. So to basically explain this in a better way to understand these perspectives, it's always helpful to consider several dimensions. What are the strategic priorities? What's the risk? What is the timeline these different people and stakeholders are looking at? And most important, how is success defined? And what I want to do today is I want to look at two types of businesses. Founders. I really think the term startups is overused. So I much rather look at it as founders, so newly started companies in an earlier stage of their life. Then mid-market businesses, often family businesses, medium size, and the corresponding investors. So the VC, who most often invests in the earlier stage companies, and private equity investors who go into the bigger businesses. So let's look at these four dimensions. And I added ownership goals here, but that's really just to complete the picture. So how do you characterize a founder? Founders are in an earlier stage, prioritizing vision and innovation. And time horizon is long term because there is nothing yet to understand where will this go to. And oftentimes higher risk because we're talking about proving a product, proving a market, proving product market fit. And the definition of success is really to create a lasting business, create something that will be there at the very early stage tomorrow, or that will be there next week, next month. And oftentimes the ambition is to have very fast growth because when you start from nothing, your percentage growth can be very good. Going from 1 to 2 is 100% growth. That's very fast. When we're talking about mid-market businesses as a later stage, the strategic priority is really on stability, legacy, control, specifically when we're talking about multi-generational businesses. My life as an entrepreneur was in a business where I was the fifth generation. I'm a bit ashamed to say that we sold it, but it was an opportunity, it was a strategic decision, but I'm also very proud of that. And I remember one of the proudest days for my dad was when I joined the business. So legacy and stability is something that is more characterized by those type of businesses. The risk profile is relatively low compared to the smaller, earlier stage businesses because it's all about preservation, improvement, and legacy. And the definition of success is steady income, steady growth. We're talking sustainability and again, succession. Now, when we compare and contrast that to the investors, we have the VC investor with prioritizes strategically growth, 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 and market size. Recently, I've been to a meeting with the first fund I ever worked with, and the founder of the fund, the general partner, said, our most successful investments are the ones that have billion-dollar markets. And we have stopped looking at companies where the market is too small. Number one for all our due diligence, what we look at first is the market size. And then obviously scalability, growth opportunity, etc. But market. Risk profile very high, which is in the nature of the business model of venture capitalists. And now these are the parts that are important to understand for all of you who have not been involved in fundraising processes before. The high risk, the willingness to take high risks is coming from the basic business model of a venture fund, which is in their definition of success here. Every single investment is targeting at least 10 times the money. And only a few of them need to be successful to create the type of returns that the customer of the VC fund wants. Has their investors. So there is a clear idea that the VC is able to take much more risk than the underlying company because only one out of maybe 5 or 6 companies, maybe 1 out of 10 has to succeed. The other ones are calculated risks that they fail. So there is a discrepancy that you need to understand. That's the portfolio view. And the time horizon is very specific as well. It's not long term, it's not short term. Time horizon is determined on the business model of the VC. Fund lifetime is 8 years. 4 years to invest, 4 years to exit. So very specific. It's very important to know when it comes later to communicating with the investor to make sure that there's an alignment between the time horizon of your company and the time horizon of the investor. When we're talking about private equity, the strategic priorities they are looking for in companies they're investing in is there is profitability, there is cash flow, and there is a path to an exit. Why is that? Because the risk profile is medium to low. So private equity investors look at a very important point that is how much money is there to support the strategic initiatives that they want to bring to the table. And one of the important strategic initiatives is leverage. So how much can they borrow to invest in your company? And the definition of success there is predictability, less return than what the VC investor wants, but they're looking for a higher hit ratio. So instead of, let's say, 1 out of 10, that is a success, they want 3 out of 10. And the definition of success here clearly is a strategic sale and a way how to exit in a fast, relatively fast way, in a controlled way. So when we're looking at this picture right now, and we're looking at the different stakeholders, you see that the ownership goals are very well understood. The risk profile, founders versus VC investors, both are at the higher risk category. Mid-market business and PE are the medium risk company. The ownership goals basically speak for themselves. Who owns the company initially? Well, the founder does, the business does. VCs are looking for minority investments. PE investors look for control transactions. The big difference is in the time horizon and the definition of success. So those are the areas where you as a CFO need to make sure that the way you tell your story, the way you explain the company needs to be in terms that correspond to the definitions of success of these investors. And they don't clash. They are directionally the same. So what I did is I basically put together a profile of many of the CFOs I've been working with, and it doesn't have to apply to each and every one of you. But I think on a high level, I've done a couple of fractional CFO jobs myself. The best way I can summarize the two primary goals for a CFO is that on the internal side, it's to ensure financial health and enable strategic decision making, which gives you the insider view. But at the same time, the CFO also is responsible for aligning the operations with the expectations of outside or outside or quasi-outside stakeholders. And I add the board here because a lot of you have seen that when you communicate with the board, they have a quasi-outside perspective. So importance here is that the CFO will act as the translator, the bridge between the inside and the outside parties. So when I look at what we're trying to talk about today, this should give you on a very high level an idea of what is the key importance about these, the alignment. What is the key difference that you need to take into account when you're talking to the investor? It's the definition of success and the very specific time horizons that the investors have versus a much more flexible time horizon you are looking at. Now, let's go into the most important tool that you have in your toolbox. The financial model is essentially one of the anchors of any kind of due diligence a investor will do with when they consider an investment. So investors typically evaluate companies based on business model scalability, on predictability of revenues, on the balance of growth and profitability, and on any kind of identified risks and mitigations. And all of that can be shown in a financial forecasting model. So what does that mean? Typically, you can do two forms of financial models. There is an overview model, and there is the full financial statements. Full financial statements is a detailed P&L, detailed cash flow statements, and detailed balance sheet. But for investor communications, at least in step one, let's say an adjusted profit and loss statement, which I would call an overview model here, is the thing that gives them an insight into those key points I just mentioned. How does the business model work? How are revenues being generated? What is the growth path and the growth perspective the company is going to be on? And what are the risks? So an overview model, the most general overview models I've seen start at the top line and at the EBITDA with some summarized information on how money is being spent. So your typical SG&A, your typical R&D expenses, your typical sales expenses. And then they add a segment of the cash flow statement that shows what does that actually mean and the requirement and the spending of money. Because what the investor eventually does is they give you money to work with. So what is helpful on the overview model is to say what is happening to cash over the next time period. So the general form of this model is the same for venture capital and for private equity. And I've found a model that of an investment that I've led several years ago, and I thought this is a good one. I anonymized this, so in the interest of confidentiality. But it's a little small here. You can maybe take a look later when I share this presentation. But if you look at how it starts with revenues. This is a company that has software and hardware. That's why I picked this. It shows a level of detail on how different revenue streams are generated. It shows the cost of goods sold to get to the gross margins. Again, it shows the scalability of product, a summary of the operating expenses leading to net operating margin. And then most important to have the cash burn at the bottom. See how much cash is going to come in using assumptions for cash collection and how much cash is being spent on operations. So what we see here that in this specific case in 2022, the company was forecasting to have a cash burn of 3.5 million, in 23 of about 4.5 million, meaning over the next 2 years, they would need $8 million to execute on this plan. And that's essentially on a high level what you want to show first. Now, what does that mean for creating a model in general? There's a couple of best practices because what you want to avoid in creating a model is yellow flags initially. So I put together a couple of rules on how to put together a financial model and what it should have as a minimum. So typically, what investors like to see is 2 years of actual historic numbers, fully audited as long as they are available, but it's also well understood that for the last quarter, numbers are typically not available fully audited, but they're good enough as you have them out of your accounting system. Preferably quarterly, but on request monthly. Forecasting period minimum of 3 years for VC as well as PE. The most critical forecasting period is the first 12 months. You should typically try to create those monthly and then at least another 2 years quarterly. And when we're saying first 12 months is like if you're in the month of June, you want to do June or July to June and not just the rest of the calendar year. So really talking about actual next 12 calendar month monthly. Also important, the model should have clearly stated assumptions that are underlying the forecasts. So explain what is the price of my product? How many of these products do I sell per contract? How many customers do I have, etc. So it needs to be clearly stated how the business model works and how it scales financially. So this takes into account potential discount. It also takes into account higher margins for bigger contracts, etc. So the first two parts, the sales and the cost of goods sold area, need to reflect how the business model works. It can never harm to explain specifically in a separate slide, this is what the costs are, this is what our assumptions are on sales per customer, etc. It's also very important in this model when you look at it that there's a continuation from historic and actual numbers to forecast. if there is a sizable change in growth, if there's a sizable change in the financial ways and how the business model works, it needs to be explained, and it needs to be explained in detail. Those are things that will always draw attention and always draw questions. I know that I shouldn't have to put this here, but you wouldn't believe how many models I found where things don't add up. If I take the top line, I subtract the cost of goods sold, I subtract the operating cash, and I do get to a different number, what is in the model of what is shown in the spreadsheet I got on EBITDA. That happened more often than not. So I apologize for putting this here, but I figured it's really important to do that. And then the other thing they want is what I mentioned earlier. In order to identify risk and mitigations, it's really important to consider making 3 scenarios: a downside, an upside, and a base case. Now, when we look at this, I said there's different type of investors, and this needs to be, or is better be tailored to these investors. Let's look at the early stage and venture capital investors. As I mentioned before, these guys focus on the top line opportunity. So the major valuation driver in a lot of early stage transaction is the sales multiple. So the value that an investor assigns to a company and the value they will propose at which they invest is a sales multiple. In industrial spaces, the typical forward-looking enterprise value to sales is in the area 8 to 10 times in the earlier stages. So that's something I know from the top of my head. It's different in different areas. Financial services or fintech has a higher multiple. Consumer tech has sometimes a lower multiple. Crypto has a higher multiple currently, but in the earlier stages, the major value driver is sales. And venture investors looking at fast growth, sales typically expected to double or triple over each year, the first 2 to 3 years. What's important for the first 12 months, a certain amount of these forecasts need to be supported by an existing pipeline, and even more important, by market data. What I said earlier, the market needs to support a growth path. And so a decent level of detail is required on how growth will be achieved. And key metrics here: total addressable market, the growth rate, unit economics. And I put burn rate here, although it needs to go at the bottom line, but it's the really important one that shows, am I going to invest or not? And a common mistake that often is made in financial models that I've seen is that there is a misalignment between the pipeline, the market opportunity, and the go-to-market approach. So is the pipeline and the market opportunity and the sales, do they correspond to each other? When we're going to the bottom line, the interest or the focus is on use of funds. So profitability is often a longer term target. Sometimes profitability cannot even be achieved or improved in the investment period that you are currently looking at. The use of funds is mainly in salaries, sometimes in working capital. And again, here, the section on cash in, cash out, and cash burn is critical. Let me go back to the model I showed before. So see the bottom line here, the 3.5 and 4.25 million burn in 22 and 23 show the minimum capital that is required for the next 2 years. If I left that out, we would see the net operating margin shows that a loss of 7 million is there. That does not give the complete picture. And VCs pick up on that right away. So it's really important to have that section in there and have that cash burn align with the funding strategy, and also see the 3 scenarios that I suggested. Does that correspond to the funding requirements? Now, for mid-market and private equity transactions, it's a combination of top and bottom line development, but with a slightly different focus. The top line focuses on a quality of revenues and forecastability. So the expectation is that there's a higher percentage of the first 12 months forecasts to be already in the bank. So what you want is you want to be able to show how much of the next 12 months is revenues that are already contracted, revenues that are coming from current customers already, expansion within current customers versus greenfield opportunities, new customers. So that's the kind of information you want to have to back up the top line. So quality of revenues are really determined by the recurring nature of revenues. And as I mentioned, the expansion within the current customer base. There are metrics for this that are really important, that are used, that also should show up in the model somehow. Customer acquisition costs, LTV and churn, so lifetime contract value, and information about the sales cycle. In mid-market companies, you should be able to draw upon history. The last 2 years, maybe longer, show at how well these metrics have developed and how much they support the quality and the forecastability of revenues. So in contrast to the earlier stage where it's all about growth, in the mid-market transactions, all about quality and forecastability of revenues, specifically the first 12 months. When we're looking at the bottom line, the rationale and the strategic priorities and success definition for private equity companies are really building on a foundation of profits, existing profits. How can these profits improve and how can they be used? When we're talking about improvements, obviously we're talking about improvements in margins, cash collections, all sort of operational metrics. When we're talking about how can they be used, we're talking about leverage. How much can the existing profits, cash flows be used to improve the capital structure of the business? Also, what's the impact of scalability? Can there be improvements? And it's really critical here to see a clear progression from the historic actuals as a proof point to the forecasting period. All right, so this gives a little bit of an overview visually. Again, it's just a reminder of what I just said. If you look at the idea what you want to do as a CFO, you want to tailor your model, you want to tailor your strategic tool to the audience. If you look at the top four categories here, you see that the dark orange bar shows how much private equity people prioritize exit modeling, debt capacity, cash flow, and historic earnings. While in the bottom, you see how typically venture capital investors prioritize those different areas: market size, unit economics, burn rate, and revenue growth. Okay, so how do you create this alignment? This is more of a summary slide. To see how can you tailor your story to the perspective of the investors. On the top line part, we're talking about presenting a growth thesis that is aligned with the market. The factors here are stuff that's also going to come back in the data room, have a good idea of what the market landscape is, the competitive position, and where's the expansion potential. And the goal here for you as a CFO would be to explain scalability and align the growth expectations of the investor with the strategic plans that you are having. The other thing that's really important is having consistency. So you can avoid all kind of misunderstandings which is another way to say create alignment. Alignment is having no misunderstandings, being on the same page. Does the top line reflect the stated and planned initiatives? Does the operational development reflect the business model? And is there a consistency between the history of the company and between what the forecasts are? And the other thing is show proof points. So show that what you say is not out of line, that there is a way to say this is how the industry works. How do we compare to peers? If the industry works at a certain profit margin, we're going to work at least at that profit margin. We can do this and we can do it better because, and that because is where the differentiators that differentiate us from the market, from the rest of our peers, that support the strategy that we have shown and that aligns with the goals of the investor. So overall, getting back to what investors focus on, business model scalability, predictability of revenues, that's where the top line comes in, balance of growth and profitability, that's where the proof points come in, and risk and mitigation, is all of these three items have an important point on understanding risk and what an investor wants you to do and what you can do. So you're demonstrating a good understanding of your business in terms of the investors' evaluation, investors' KPIs, and the investors' understanding of what they want to see. Okay, now modeling is not something that you start from scratch. There's a lot of tools out there, and I want to highlight a few here. There is plenty of free and paid tools, so it's not necessary to start anything from scratch. What you not necessarily want to do is you do not want to use an altered version of internal budgets. What you want to do is you want to create a financial model that is backed up by your budget, but not the same as your budget. Because the financial forecasting tool is depending on what you want to do, assuming that you successfully raise money. So there is an additional dimension to this, and that's what the investor is looking for. And there's a lot of templates out there that you can use as a starting point and then tailor to your needs using the things that I just mentioned, tailoring it to your audience. So eFinancial models, OpenVC, and Smartsheets, those are three examples here. You will be able to find plenty of more of these where you can find a good starting point. Oftentimes these are SaaS-based, but there's also plenty of other models out there that plenty of templates for product companies, for service companies, etc. And if you are willing to spend money on this, or if there is available budget, there's also software tools like Forecaster is probably the biggest one out there that can also be integrated into your accounting tools that can pull in historic information, pull in stuff from your CRM to help you forecast easier. So this is not something you want to start from scratch. And I'm at the 30-minute mark right now, so I think I'll do a very brief thing on data rooms and then move to Q&A. Data rooms, the important thing is for any due diligence or any kind of attempt to do fundraising, you need to prepare a data room. And why does that matter? Well, a data room is the central repository of information that helps investors with their due diligence. There is basically a lot of information in there to back up your pitch story and to back up your forecast. Oops, sorry. Also extremely important, the data room demonstrates to investors that you are organized. A good and clean data room is actually something that stands out. There are plenty of data rooms out there that are really not well organized, that are not consistent. And important is that your data room is organized. It shows that you have nothing to hide. And it also is a demonstration that you have really good control over your business. This is something you can look at later. This is like a big overview of what a data room contents you should have. A data room should have information about the company, including the pitch deck. It should have information about the market, about your product, about finances, and a basis about legal. So there's a lot of stuff on here. I don't have to go through this piece by piece, I believe. Same thing as with financial models. There are plenty of tools and resources out there. Do not create a data room from scratch. Here's a couple of example links for templates. And typical tools for sharing is Dropbox, Box, or DocSend, stuff you should be very familiar with. Again, there is tools that are a bit more expensive. Dealroom is one, and there's also a link here to a list of other providers. So a couple of brief recommendations here. Do not share the data room with just everyone. Somebody who had a brief look at the deck and says, oh yeah, give me the data room, you need to evaluate the investor interest level. You need to get the idea that there is, at least has been a detailed call with an investor, so you can see, are they just looking for information from anyone and just, not really interested in investing, or is there a legitimate interest and this is a way for them to double click into the deck, into the first investor presentation, into the conversation. And then there are different layers. You can start with a basic data room, decide which information you have that you do not want to be everywhere easily. And then you can always expand. You share information if requested by investors. A data room is a living, breathing organism, so to say. They evolve over time. And you can learn from questions, from things that are requested by investors, say, oh yeah, this is something that convinced investors to go to the next step. I want to add this to the general data room and share this with other people as well. It is absolutely okay to request NDAs. A lot of you will receive, you need to expect some pushback. One of the general things my fund said, the GP said, I do not want to sign NDAs until before I reach a certain level, because if it goes out in industry that I share information and data and I'm not trustworthy, nobody will give me information anymore and my fund is dead, which is true to a certain extent, but it's always okay to request an NDA. So if you get pushback, you need to decide on a case-by-case basis, but it is okay. So quickly wrap this up. Key takeaways I want you to have from this overview today. First of all, as I said, I'm at a 33-minute right now. I'm wrapping this up. Typically, these kind of conversations I have over several sessions, several hours with individual people. So I hope on a high level this has been useful. Companies and investor perspectives understand that they do not conflict. The perspectives are different, but it's your opportunity as a CFO to create alignment by tailoring your story to these perspectives. And I hope you got a little bit of an idea on where the key differences are in your point of view or the company's point of view and the investor's point of view. VCs and PEs have different perspectives. So you want to help them answer different questions. And that will help you to increase the chances of success to get to the next round of conversations in the due diligence. And it's up to you. So the CFO is typically been one of the most helpful people in the company to an investor to understand what they want to invest in. And on data rooms, very briefly, data rooms are easy, but they require discipline. So with that, I'll just stop here. I'll share this presentation later. My contact information is in there. If you want to reach out to me afterwards to have some follow-on questions, very happy to answer questions. And I'll move this to Q&A. Chris, do you want to take over to
Thank
start with?
you. Yeah, that was really, really insightful. And I can see how, there could be so much more time spent discussing the various elements. But really good overview, Ben. Thank you. Yeah, definitely want to open it up. Just want to make the point that this is being recorded, so just don't share any confidential information. We have got a couple of questions already. Rick, I think, kind of figured out his own answer, but Sean Grimm, do you want to ask your question?
Yeah, thank you, Chris. Just as many other things that occur within a company, I see the CFO as kind of the linchpin to making sure they occur. Can you talk about your perspective of how you bring, I'll say, other executives into the discussion and have the appropriate alignment as to what goes in the pitch book and how additional discussions or presentations may occur?
Yeah, that's a really good question. So actually, in my experience, it is typically not just the CFO who leads the discussions. You should try to make sure that the relevant people for the relevant topic are included. So you have, as a CFO, what you want to do is you want to brief the CEO on the topic at hand at a different kind of call or when different questions are there to make the C or your colleagues on the C level or whoever is there aware of this point of view of the investor, and then bring in the right people for the right questions. So a good investor during due diligence will request the CEO for the big vision. He will request the head of sales to get an idea about the pipeline, about the go-to-market. He will bring in the CFO to get into the financial parts of the questions they have and say, how does the story I heard from the CEO and the story I heard from the head of sales, how does that translate into your forecast that you gave me? And that way you bring in the right people for the right question. The key takeaway from what I said today is make your colleagues aware that they are talking to an investor, and this is what the investor is looking for. typically those people understand really well once you tell them the difference. And actually, what I also found is, for example, people like a head of sales are very, very enthusiastic and very grateful if they're brought in and they are briefed and say, hey, you're instrumental in explaining this. Make sure you're explaining it this way. And, oh, yeah, thank you for the opportunity. So I've had very, very many situations where I've either been coaching companies to do that or whether I've been an investor on the receiving end, where people really try to present what they do and wanted to show that they know who they're talking to. Very rewarding conversations for both parties. Does that answer your question?
Yes, thank you very much.
Of course.
Perfect. I'm going to say Steve W, so I don't completely butcher your name, Steve.
Oh, hey, Chris. Yeah, so I was just stressing the importance of the NDA, just because, you always want to protect your information, especially when you're giving access to lots and lots of information, more than just, say, the initial presentation, that we had an internal requirement that we needed the NDA completed before giving access. That's all.
Okay.
Yeah, and as I said, I do agree with that, absolutely. However, if there is a situation where where an investor requires a data room and you think it's a really high potential and a really potentially good partner, you can tailor the data room. What you do is you take out the technical information about your product. You take out very detailed information about the pipeline. You anonymize it. You you can still leave in the financial model, but you do it on a lower level of detail that does not give insights into your pricing, for example. You can still provide your sales material. You can still provide some of the research you have about the market size. So you can create a data room that is taking out everything you are concerned about and still provide the investor with some information that they can decide, okay, yes, now I want to sign an NDA and move forward, or no, I don't, instead of slamming the door closed. But I'm 100% with you. That's why I mentioned that it's okay to ask for an NDA.
Yeah. I agree. There's different ways to tailor it for sure.
Yeah. Thanks for bringing that up. Yeah.
Yep.
So there are no more questions in the chat. I don't know if anybody's got any experiences, not necessarily a question, but any of their own insights or comments, experience that they want to share.
Okay, there's a question from Rick, which I think is a really good question. I'll quickly read it out. Great presentation. I very much understand how important the different perspectives are between investors, founders, PE, etc. But I wanted to ask a little bit more about alignment. Arguably, the perspectives are simply different. So how is it being suggested that the CFO should help to create alignment between these perspectives? And I think that's a really good question. The thing is, if you as a CFO perceive that the perspective is insanely different, then I would ask myself, why am I looking for external funding? So if you are looking for external funding, you need to be aware that you not just get money. If you only need money, you go to the bank and get a loan. If you cannot get the loan and you need to bring some additional money in, you bring in a partner. So bringing in a partner means that you need to take into account that the partner has wishes as well, because they're going to be a co-owner of your business. And if you find that you are not able to bridge the gap between the partner and the company, then that means two things. One is, this is not the right partner for you. The other thing is, your company is not the right investment for that partner. If it is a private equity transaction and the company comes in, this partner comes in and says, hey, I have these plans, and that totally, you cannot make it work, then that just means that that is a company that is very aggressive, or that's an investor that's very aggressive, that sees something and they want to take control. And if they have control, you have very little choice. But if you really want to bring that partner on board, that means you see something in that partner and you see something in that partner's strategy. And that should give you the opportunity to create a minimum amount of alignment that enables both parties to move forward in the due diligence and come to a decision. Are we going to start this partnership and accept your money? And on the other hand, am I going to accept that partnership as an investor and invest in this company, buy a stake in your company? So I hope that addresses the topic as well a little bit, because if you really cannot make this alignment work, you're not the right parties to partner.
Scott has made a great point. Scott, do you want to just expand on that?
Sure. One of the other things you might want to highlight, I say this coming from both the investor and the operator side, is the specific success your past teams have had. In the ideal world, your team has worked together, or let's say you've got 5 executives, maybe 2 or 3 of them out of the 5 have worked together and had these successes, but highlighting specifically what makes the individuals qualified for the role. So for example, a sales VP, if they've taken their last 3 companies from 1 million to 100 million, that's obviously great. But even within that broad range, well, it's a great track record. It takes a very different skill set to go from literally founding with $0 of revenue to say 20 million in revenue versus what it takes to go from 20 to 50 or 100. And then
100%.
From the CEO's perspective, specifically what he or she has delivered in their past. So very clearly, everybody's in this to try and maximize returns. But if you've got a CEO that say produced 5, 10 times return on money, you want to highlight that, but specifically highlighting them kind of like tombstones for deals. So if they've raised $20 million and they've returned $200-300 million, highlight that. And then additionally from there, so you can highlight the individuals, like basically what makes them qualified for the exact role they're coming into. But in the ideal scenario that some of your team has worked together. So again, in the 5 executives we were talking about, if you got 3 out of 5 of them that have worked together, so the 20 million investment to $200 million return, saying these 3 out of 5 of us are working together again, so that it's good to have the individuals that have delivered it, but it's better and stronger if you got the team of people replicating what they've done in the past, ideally in the somewhat same sector, but not exactly the same.
100% totally agree with that. Today I was trying to focus on this alignment from the financial perspective, from the perspective of what the translation of let's say opportunities and market and businesses into where the company is going financially. When you are talking overall from pitching your company to an investor, 100% team is always, has been, still is, and will be the number one thing. And as a CFO, Scott, great point. You don't just want to show, oh yeah, they have done this, that, and that. You want to quantify that. You want to say exactly what you said. This team together in their previous business have done this or that. Or right now, this team has led the company from here to here, but I can show they have the qualification to do the next step. What I've seen a lot in the venture capital business is that when companies are going from the Series B to Series C stage, so they raised their 3rd, 4th round of capital, that the founders, unless they have been serial entrepreneurs, are getting into a situation where they are overwhelmed with the CEO role. And often investors are pushing for the founders to take a step back, to become a visionary, to become a, to take a different perspective in the company and bring in a professional CEO who understands how to scale an organization. So the founder goes into driving sales, going into all sorts of other activities that are still highly important, but they bring in either a CEO or let's call it a COO, doesn't matter, a person who knows how to scale an organization. So 100%, absolutely. Team, 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 and then the rest.
I actually have a question, Ben, and it might be really basic. I'm not a CFO, obviously, but when I speak to CFOs, it always surprises me when there'll have been some kind of transaction, usually PE backed, and it transpires that what they thought they were buying into is not what they've bought into. So I was just interested when you talked about like the forecasting piece, the strength of the forecast hasn't been, I guess the due diligence hasn't been done, and it actually wasn't they thought it was going to be. How does that happen?
Well, number one, forecasts are forecasts. So they're never certain. And that's why I try to highlight the quality of forecast, the quality of sales, the quality aspect in it. When you prepare a good model, and it's not just when you prepare it, when you buy a company, it's the same thing. when I looked at potential investments, I look at quality of forecast, quality of revenues. So let's say my next 12 months forecast are 10 million in sales. What I want to know is how many of these 10 million are already in the bank through either existing contracts, through recurring revenues, through all kind of things that have a high level of forecastability. That's tier one. Tier two is in my pipeline. What are the top 5 or 10 deals that are in a stage where you think they're going to close within a certain amount of time? And so I'm trying to get to understand how much of the forecast is still at risk. And in a lot of cases, that is very little. And the fewer of that is already in the bank, obviously the higher the risk. It also means the lower the valuation I'm willing to pay. And the more I need to be aware that the outcome I have seen is not likely to be the outcome I'm getting after I bought the business. And a good investor does that. And the same is true for the other lines when you go down through the P&L. You look at, does the hiring plan for salespeople, for the cost, does that jive with the sales plan? If I'm totally underspending on my growth in my sales team, why do you forecast that amount of top line growth? Those are all kind of questions that an investor who does deep due diligence will ask. That's what I meant with consistency. And that consistency flows down through the model. And there will always be people who are insanely diligent and they will double click down and down and down and down. And they will want to see customer contracts, how they scale. And so the earlier stage your company is, the less reliable your forecast. The later stage your company is, the more reliable is the forecast that is an extension of your history. But then the part on top where you say, this is why I want your money. This is why I want want money in, because I see this opportunity I want to capitalize on. So I'm investing here, and that's the outcome I'm expecting. So the better you make that case, the better you explain the case, the better the investor can shape his own opinion. And I have to do that. Every investor has to create their own conclusion on the information you have provided on, do I think this is realistic? And if they turn around and say, yeah, but this is not what I expected, it's like, yeah, that's what you expected. I gave you all the information you have. Don't blame me. Well, it's not exactly like that, because you still need to perform because you promised something to a certain extent. But yeah, that's how I would look at it. Rick did the hand.
Yeah, thank you. Hi. This has been great. I'm a fractional. I work for a few hard tech companies, one of which was in biotech and failed. They were VC, had very limited revenue, good science out of a good accelerator type group. Couldn't find an additional co-lead, and they had to wrap up. Their existing investors, purportedly were climate friendly and had a long-term perspective. And I've just found that that's just not true at all, despite what they say. I think what you said in terms of their goals are, maybe 4 to 8 years max. And my question is, for hard tech, revenue is usually quite a bit farther away than a typical software SaaS company. Relative to, so with that perspective in mind, do you have any suggestions on either like the financial model? We're not getting revenue in this one thing until 2028, 2029. And we'd like, a few $1 million now, and then you might get some revenue in years. And that just doesn't work for a typical VC approach. So with that particular perspective in mind, have you ever found opportunities to find, quote, patient investors or investors that may have that type of timeline in mind? I'll just cut it off there, but hopefully that question makes sense.
Absolutely. It's one of the most difficult questions that that you can get. how to find the right investor is a skill. Now, specifically when you're talking about hard tech, and when you say hard tech, you mean hardware tech, right? Not deep tech.
It could be deep tech, but just the typical, like, not just something where it's, you sell a widget, you have a markup, like you're developing something that's really hard and you have to take it to market and you're talking years. So whether that's hard tech, deep tech, whatever, however you slice it, just the revenue horizon is just brutal. And there's more science. The risk profile is way more science. You need grants, you need those types of things to get it really moving, because it's not just you get the coding to work.
Yeah. So there's one segment of investors that are really hard to get, but that invest in these things, that are family offices from high net worth individuals who come from those areas, who have a vision and who have such a deep understanding that they're willing to take those long-term risks. That's number one. Number two, there are really hardcore deep tech funds, specifically in biotech. Now, I'm not that familiar with that segment. I'm really more in the automation space, where I have deep experience, automation, robotics, etc., where the automation players don't have that like 5 to 10 year horizon before revenues things, but the robotics people do. And the successful robotics companies, they have either successful backing from these individuals, or when they were very lucky because of relationships, they have strategics in there, but with small amount of money. Strategics meaning corporate venture capital, those kind of companies. For the rest, it's really, really difficult. It's an art to find these specialized funds. In biotech, there are these funds. I cannot point you to the right direction right now. That is something for asking the question, talking to early stage investors and say, hey, do you know anyone in that space? This is about ringing the doorbells everywhere, not just asking, are you interested, but also asking, do you know someone? In biotech, also, there is one really good accelerator I know. It's called IndieBio. And IndieBio is a part of a venture fund called SOSV out of San Francisco. And IndieBio is this accelerator. And SOSV has two accelerators, IndieBio and HAX. And HAX is a hardware technology accelerator. Now, a way to go there would be to ask them, do you know investors in that space? Because it sounds like this is not the kind of company who would go through an accelerator. They're probably too specialized, but that would be a way to go, to ask, do you know these specific funds? Is there somebody I can talk to? And not necessarily even asking for an introduction, just ask, do you know someone?
Yeah.
Otherwise, for those kind of companies, specifically when we're talking that long out, it's family businesses, high net worth individuals out of that space. And then there's this thing, as you said, crawl yourself from one grant to the next, scrappy from one grant to the next. Unfortunately, that's the only successful chance I have seen. And the other thing about the financial model, screw the financial model. It's not worth it. The business model and the market is. This is how big the market is, and this is what people will be willing to pay for. Those are the financial things to look at. Don't make a P&L. Waste of time.
Got it. Yep. I thank you. I agree with all that. Unfortunately, the contract or the grant market is a little bit difficult at the moment. We've been doged. So
out of overseas.
Yeah, we pivot there. Yeah. Okay. Awesome.
Look
Thank you so much.
Now.
Thank you very much.
Sorry, I wish I could have like, oh yeah, call this, that, and that guy, but
no, that's good.
Cool. Well, I'm conscious of time. We're 1 minute past. I think this has been an amazing session. Really appreciate the time that you've put into the preparation and the delivery. Ben, thank you so much. I'll share the presentation deck with you later today as a follow-up, and Ben's contact details will be on there. So if you want to kind of have a conversation offline, I'm sure you'd be happy to do that, wouldn't you, Ben?
Yeah, absolutely. Thank you for everybody for dialing in. Thanks for all the questions. Really been good question and interesting. So as I said, so I'll have to convert the presentation into a PDF because I worked on this until this morning. But I have my email address and contact information in the back. And if you have any questions, please feel free to reach out. I'm happy to follow up. I'm on Eastern time, so just so you know, should be easy for everybody wherever you are to reach me, because I'm always the guy who can sleep the longest.
There'll be some other links on the email as well, just some resources that are available to you from CFO Recruit. And with that, I will bring the session to a close. Thank you.